My name is Zach, and this is Dividend Data. Like many of you, I'm investing for my financial future. That is a future where I have a source of independent wealth so that I am not forced to work a job I hate or live in constant fear of losing my actively earned income. That is true financial freedom. Despite investing and personal finance being so important, it's really not talked about that often. In fact, some consider it rude to talk about money. It's looked at as a taboo topic. It's kept private. So how are you supposed to actually learn about it then? It's not taught in schools, and most people don't want to talk about it. Well, on this channel, I try to play a small part in changing that. Every week, I transparently show what I'm investing in, how it performs in the market, and all my new buys. I share my journey as a 25-year-old investing for my own financial future. At the start of every month, I do a full portfolio update on my long-term dividend stock portfolio. Today is one of those videos. I've been updating you guys on this account since it was around $30,000, and I've now grown it to over $168,000. And that's down after a bad week. Throughout the video, I'll discuss my investing strategy, share my new buys, and give you a full update on the account performance. However, the main topic for today will be analyzing the top 5 stocks I own in that dividend portfolio. But first, I wanted to broadly talk about my investing strategy. Let me switch to the little computer for that so you guys can have some visuals. I view dividend growth investing as one of the most sustainable paths to reach the goal of financial freedom. Here you can build up a portfolio of investments which pay a growing stream of dividend income. That is money you can take out as cash and use to pay bills or just add to your savings. However, you can also reinvest those dividends to acquire even more investments, increasing your ownership and future dividend income. Over the long term, this creates a massive compounding effect with surprisingly great returns. In our community, we call this the dividend snowball, and you can check out one of my old videos where I go into detail about this topic. With dividend growth investing, you not only earn income, but the market value of your investments appreciate too. For example, this account has a $53,000 gain. That means you're building up a large nest egg while your dividend payments compound. The goal is to grow this dividend income to where it exceeds your living expenses. That unlocks a new level of financial security. In the absolute worst case scenario, you can pay for your lifestyle without ever touching your principal investment. With dividend growth, those payments will continue to increase, and so will the value of your portfolio. Ideally, you can keep reinvesting dividends and continue the compounding effect to even greater results. I believe this method of dividend growth investing is a great retirement strategy. Here you are not forced to sell off your assets in order to fund your lifestyle. During recessions, retirees are often forced to sell when the market value has plummeted, and that's precisely the worst time to do so. You are locking in losses. With a dividend strategy, you can continue to hold and even add during these downturns. In fact, your dividend income may even continue to grow during recessions. That is, if you invest wisely. For example, the dividend aristocrats have 25 plus years of consecutive dividend growth. If we take a company like PepsiCo and look at its dividend, this is continued growth throughout multiple downturns. This dividend has grown massively since 2008. And when you start to think about investing based off the cash flows it produces, that is when you reach sustainable wealth. So in my opinion, dividend growth investing can help create sustainable wealth that you could pass down generations. So how am I following this dividend growth strategy? Well, I'll explain it in this month's portfolio update. Let's roll the intro. All right, let's get to the portfolio update. But first, if you're wondering the tool that I use here, it's dividenddata.com. This is a stock research platform that I created in order to help me better find and analyze stocks. It also lets you track multiple portfolios and create a watch list that lets you more easily find which stocks are trading at a discount. But some of you may have noticed some changes. I just put out a really big update. First off, I just made a stock screener, which helps you more easily find different kinds of companies. It's pretty fun to play around with. I've already made some use of it. And then you just do an easy click, and then boom, you're in your stock research tool. And this has full financials on all these different companies. And I did bring up Salesforce for a reason. They just fell 20% today, and they're one of the new dividend growth stocks that I think will be a fantastic addition to many of your portfolios. I have it on my watch list, and I might be adding, perhaps I'll do a stock review video in the future. I don't know. We'll see. But then I also add this clear selected ticker button. Before you could do the backspace, but now this makes it much easier, especially on mobile devices, just to clear that. And then, if you want to go to a different one, a censure, boom, and clear that, boom, you're out. I also added a new dividend screener. And on this, I actually curated lists of great dividend stocks that could be in your portfolio. I have ones focused on high growth, high yield, and then, of course, I put the dividend aristocrats and dividend kings in here. And this is really just a great foundational base to get started from. And this dividend screener takes you to a specialized research page only with dividend information. You have your snapshot. It tells you the current yield, the forward-looking dividend, the frequency of the dividend, when the next payment should be. And then you have your dividend growth summary over 1, 3, 5, and 10 years. A full history, often going back up to 50 years for some companies like Coca-Cola and PepsiCo. You got a table showing each entry and the individual growth rates when that happens. Then you have the payout ratio of the stock, which is very important if you're analyzing dividend stocks. I have payout ratio based on both free cash flow and net income. An important distinction that I've explained in other videos. I'm not sure we'll get into it today. And the historical dividend yield of the company over time. All of this is a great addition in my opinion. There's even more. I added this R stock picks, and this is still in the early stage of what I think this page could be in the future. So on this, you can see my watch list, all the stocks that I choose to track, which again, it can give you just a great foundational base to look from. And then you can also get access to my dividend stock portfolio, the exact thing I show in this video and track in myself in the portfolio. So if you go on dividenddata.com, you can use the exact thing I'm showing throughout the video in my account. And then if you like how that looks, you can of course just track your own portfolio the same way that I do. So this is a new update. I'm actually hoping to increase the pace of updates. I want to add way more value for you guys. And if you want to be a part of that, now may be the best time in a while to join. Why? Well, I'm announcing a exclusive, large, massive, huge summer sale. This is a big announcement. I'm announcing a 50% off summer sale. That is 50% off the monthly plan and the annual plan. That annual plan is already a $100 discount from the monthly plan, and now both are 50% off. And it's important to note that this will be lifetime pricing. And this crazy deal will only be available for a limited time to new customers. All you have to do is select the annual plan or the monthly plan, enter the coupon code SUMMER, hit apply, and boom, 50% off. Again, I want to emphasize that this 50% off plan will only be available for a limited time. So you want to jump on it right away if you want it. And I had an even more fun idea to boost this sale. I will be doing a randomized giveaway to the first 100 people who sign up to the annual plan. I will select 10 of those people and they will get a merch item of their choice sent to them free of charge, such as this Buffett Munger 24 sweatshirt. Make dividends great again hat. So that's enough of that. I had two big announcements. Product update plus summer sale. But let's get to the real meat of this video. Let's look at my long-term dividend growth stock portfolio. I'll close this down so you guys get a better view. The current total value is $168,700 with $114,900 invested. That brings it to a total return of 46.74% or $53,700. Now in this account, I have 14 total stocks with it heavily weighted towards my top holdings. I'll dive into those top holdings later. Remember, I'm doing a whole top 5 breakdown in this video. So yeah, the diversification of the count, I'm heavily weighted towards technology, about $67,000, followed by consumer defensive at $31,000, financial services at $27,000, energy at $25,000, communication services at $13,000, and then industrials and consumer cyclical are almost not worth mentioning. But in terms of stocks, my top 5 is nearly 70% of the total value. So this top 5 breakdown really is my portfolio right now. This account generates $4,683 in annual dividend income. That's $1,170 every quarter, $390 every month, $12.83 every day, or 53 cents every hour. The income is not evenly distributed month by month, which I am okay with. That is because most of my stocks pay quarterly and they're on different schedules. For example, we just had May, and that's my lowest month by far in the calendar. My projected is around $90 for that, and only 3 stocks make that up, being Apple, Enterprise Product Partners, and Starbucks. But then June is going to be much larger, around $494. That includes Chevron, Kroger, Microsoft, Visa, Exxon Mobil, Broadcom, and T. Rowe Price. Exxon and T. Rowe are my big payers in that one. And then July is my big month. That's $614.80. And this is really led by a massive Altria dividend at $515. And in that month, I also have ADP, PepsiCo, and my semi-annual Disney dividend. Yeah, and if we look at how my income's diversified, it is heavily weighted towards the Altria Group, ticker symbol MO. 44% of my income comes from that. And that's because it's a very high yield stock, which we'll get into later. And here you can see some insights into exactly what each stock pays me and its current yield, the yield on cost, and then the snowball effect from reinvesting dividends and how that impacts my yield. You can also see this on a portfolio-wide basis. And I mean, a little bit of a shocker here, but if you have a high yield on cost, you'll usually get more dividends from it. So here are some of my upcoming dividends. These are all the payments that are declared and coming soon. Starbucks, which will be on the 31st, which is when I'm planning to upload this video. That's projected to be about $9. And then June, you can see all these massive June dividends and a few of the July ones already popping in. So subscribe if you want to see me talk about these as they come in. And then here you can see my earned dividend history over time. Since I started the count, it's generated $12,700 in dividends. That was $3,500 last year and $1,700 so far in 2024. And you'll notice that this rate of growth was not consistent. And that was because the composition of my portfolio actually changed significantly from when I initially started sharing it with you guys. Initially, I had like 50 stocks and it was way less concentrated and it was also more focused on high yield. But I have since transitioned to be more focused on high dividend growth and total return of stock. Since I'm young and I have a very long time horizon, I want to actually match or beat the S&P 500 in terms of total return. And my working theory is that I can do that while building this base of dividend growth income as well. And it's already starting to happen. As I said, May was my low month. I got $67 from EPD and $12.70 from Apple. So far, that's just under $80 total, but then I'm going to add those $9 from Starbucks, which I'll get on the 31st, which will fit into this month. And then June, big month. And then July, that'll be my all-time high. So we got a little to look forward to. Let's take a look at some of my new buys as well. I actually have been buying quite a few stocks, but it's only in two names. Starbucks after its recent crash and earnings last month, and then Visa. Visa the past couple weeks, I have been loading up. So I just added this up for you guys, and I think I had a total cost of $2,720. And I bought 10 shares, which gives me 10 shares of Visa at a cost per share of $272.09. And that is a price I feel pretty good about long term. And why I'm doing that is I want Visa to climb up this chart in my dividend portfolio. I want it to be up there with Microsoft in the top two core positions of the account. I think both will deliver high dividend growth and total return over a long time horizon. So let's jump into my top 5 stocks. And I also want to mention real quick again that this is all available for you guys to see as well in our stock picks section under Zach's dividend portfolio. You can see this on dividenddata.com, my entire account that I just went over, including my new buys. I think I might actually add a new tab for new buys. And eventually I might even add like little research, like I'll put together maybe a little paper the same as I would do in a stock review video, just to throw in more value for you guys throughout the software. But yeah, let's get to the top 5. Okay, guys, so for my top 5, number 1 is Microsoft, ticker symbol MSFT. I have 101.65 shares. This is a total value of $42,000. With $24,000 invested, I have a 72.98% total return and $17,000 in unrealized gains. And if we click into the stock, we can go to the research page and I'll tell you more about why I select this company in my portfolio. Now, Microsoft is the most valuable company in the world right now. Its market cap is over $3 trillion, and it has reached that status for a reason. They have a dominant position in multiple high-growth areas of focus. You have Microsoft Cloud through Azure, which is up there with Amazon Web Services, AWS, as the top in the industry. And cloud services are only going to continue to grow at a high rate for the foreseeable future. And by high rate, I mean 20 to 30% annually high rate, which is significant for a company this large. And then you have the Microsoft 365 software suite that they sell to businesses and consumers. This used to be a single sale software business. Now it's a subscription model where in large corporations, they charge per seat, which is significant. But the real story with Microsoft for why it went up this much has to do with AI. If you're into tech, you know the AI revolution that's kind of been going on lately. Microsoft has invested a large amount of money into OpenAI, and they have a 49% economic interest in the company. Very weird situation. I made a whole video on it in the past. But I barely even factor in that OpenAI investment into my analysis of Microsoft. What AI really is just a tailwind behind the existing growth drivers of the company. So AI has now just become a massive product within cloud that they sell. So that accelerates that business. But then if we look at it on an even deeper level, AI will help accelerate the rate of software development and creating web applications, etc., which will only increase the amount of cloud use through that manner. So accelerating human developers like me, and then we'll eventually reach this AI future where it itself is coding independently of humans and creating all these applications, which again is just going to increase the cloud demand. And it's so obvious that 50 years from now, we won't even be able to comprehend the amount of software and programs that have been written compared about today. It will be exponentially larger, and much of that will be hosted in the cloud. And then for their other core business, they're integrating AI throughout their Microsoft 365 software suite with Copilot, and they're actually charging an additional entire fee to get access to that AI version of the software. I also discussed this in a prior video. It's a very important detail that I think will start to show up in their economics. But I'm going to get off the business side of stuff here because I could go on for a long time about that. And let's just go to the stock analysis. So Microsoft stock has done fantastic over the past decade in terms of price. I bought mostly during fall 2022 after this crash. I saw that was my opportunity. I made multiple videos about it, talking about it. I sold a bunch of stocks and I moved it all into Microsoft, a lot of it. And that was a fantastic move. And to be honest, I wish I sold even more and went even heavier into Microsoft at the time because I feel very comfortable holding this company for a decade plus. And here you can see non-GAAP earnings per share, and it has just crushed over the past decade. This is a high rate of growth. Let's dive into the key financials here. Revenue per share is growing at 11.84% 10-year compound annual growth rate. Over the past 3 years, it's 14.84%, so slightly accelerated. Net income per share is growing at a 14.05% 10-year compound annual growth rate, 18.65% over 3 years. Free cash flow per share is growing at a 10% 10-year compound annual growth rate, and that's 10.35% off of 3 years. Fiscal 2023 was pretty weak for them because they increased CapEx and AI spend. Plus, at the same time, they were having weakness in smaller business segments like PC. But we also have to factor in that Microsoft is almost through their 2024 fiscal year. They've already reported Q1, Q2, and Q3. So this annual is pretty lagging at the time, and we can already see by their performance that they're going to show growth, all-time high growth. And the business is in just great financial health. At the time I invested, they had over $100 billion in cash on hand, but they made that Activision Blizzard investment, so now they're down to $80 billion in cash on hand, which is still fantastic. And that did shoot their net debt up from massively negative, and negative is good in terms of net debt, to positive $26 billion as of the latest quarter. But that is nothing when we're talking about a company with very reliable revenues that is making $20 billion in a quarter in free cash flow. And they use these profits to reinvest back into the business, buy back shares, and increase a growing dividend. So you can see here, since 2005, they slowly bought back shares every single year, recently around 1% a year. And then they have this dividend payment, which is growing at 10% a year like clockwork. The 10-year compound annual growth rate is 10.35%. The most recent increase was 10.29%. If we look at the payout ratio, it's extremely sustainable, 33% payout ratio based on free cash flow. That was from their weak prior year of free cash flow. So 33% was a weak year for them. And the payout ratio based on net income for last year was 27.36%. So again, extremely healthy levels. This dividend payment is going to be here and reliable for a long time to come. So that is why I have Microsoft as my top position in my portfolio. Number 2, I have the Altria Group, ticker symbol MO. I have 526.27 shares, and 62.27 come from dividend reinvestment. My cost per share is $37.83, and my total value is $23,900 with $19,900 invested. That's a $4,000 unrealized gain, about 20%. This is my top dividend payer at $2,000 of annual income. I have a 9.14% initial yield on costs, which from reinvesting dividends has been boosted to 10.36%. And every quarter that pays out massive dividends to me. And here we can see Altria stock. This is the tobacco company, which primarily makes its money from cigarettes, although they have other business segments such as nicotine pouches and a new vape product that they just acquired and are launching. They're also pretty big in cigars and in smokeless tobacco products. But cigarettes is the real cash cow here. They own Marlboro, which is like the big brand, the cash cow in the United States. And if anyone here is wondering why there's a dip in the 2007 and 2008, this was when they spun out Philip Morris International from their business, and they also spun out Kraft Foods from their business at that time. So Altria used to be much larger. Now it's just the US-based business, and you can see its growth from there. So what's interesting about Altria is that it's continued to grow economically, even though cigarettes are a dying business and the volume continues to decline year after year. They raise prices on that, and they continue to grow profits from that base. And then they distribute basically all of them to shareholders via dividends. So Altria trades at a very cheap valuation still, even after rising in price recently. 9.5 PE ratio. Current dividend yield 8.63%, still incredibly high. I was buying more in the 9.5 to 10% range, but still very great here. And what I like about Altria is that it's actually growing the dividend at a pretty sizable rate. The 10-year compound annual growth rate is 7.4% for the dividend. Now, recently, it's been much closer to 4. The 3-year CAGR is 4.45%. The most recent increase was 4.26%. And they've given guidance of low single digits, so I think it will still stay in that 4% range. And this is sustainable too. Based on free cash flow for the past year, the free cash flow payout ratio was 74.57%. And net income was screwed up, which is why I don't like to look at this for some businesses, because it can be misleading due to GAAP accounting. They made a few bad investments, primarily Juul, that they had to take write-downs on. And this was like a $10 billion write-down over multiple years. So it just tanked their net income per share. But that wasn't representative of the actual cash flows the business was producing. The dividend payment was still very sustainable in that time, in the 70 to 80% of free cash flow. And I do expect free cash flow to continue to grow into the future, albeit not at like Microsoft levels, but the 10-year compound annual growth rate of free cash flow is 9.19%. That's no joke. Now, this number is helped by last year, which was a good upward swing for the company. $5.12 in free cash flow per share. That was fantastic considering the stock was trading at $40. And this was after a few years of stagnating growth. So I'm pretty excited with Altria as one of my core positions. Stock number 3 is Exxon Mobil, ticker symbol XOM. I have 163.57 shares, 25.57 of which come from dividend reinvestment. Exxon's currently trading at $113, but my cost per share is only $34.51. So I have $18,000 in total value, $5,600 invested, $13,000 gain, 230.27% total return. This is my biggest winner by far in this account. Outside of that, I have an old Tesla investment that crushed this. That's like 1,000 bagger. And by 1,000 bagger, I mean 1,000%, not 1,000 times. I wish it was 1,000 times. I'll explain why I have such a great cost per share on Exxon Mobil. I'll explain that soon. Exxon's my second largest dividend payer though, with $621 in annual income. My yield on cost is 9.29%, which from reinvesting dividends has been boosted to just over 11%. Huge, just huge. Now, my Exxon investment was almost entirely purchased during 2020. And this was when oil crashed in the pandemic. I was actually just starting my channel around then, and I made quite a few videos talking about how it was such a great buy at the time. But it was risky because they were losing money in 3 quarters in a row there. But to me, as I said back then, it was obvious that oil demand would come back and prices would return to normal levels, let alone they eventually surged to over $100 a barrel, which is when they were raking in cash. But now it's still at a very profitable level. And yeah, dude, after I invested, I waited about a year and then they just started raking in profits. Free cash flow exploded. And Exxon, I believe, is a dividend king with over 50 years of consecutive annual dividend growth. The 10-year compound annual growth rate of the dividend is 3.25%. Their most recent increase was 4.4%. The current payout ratio ranges between 20 and 45%. That's based on free cash flow. Based on net income, it's between 26 and 65% in recent years. And here again, you can see where the dividend yield spiked in 2020. This was when I was buying. And now it's down to just 3.2%. And on top of dividends, they've been using that free cash flow to buy back shares at a high rate, which I like. That's a new trend. When investing in oil companies like Exxon here, you have to factor in the variability of oil prices impacting the business. So there will be boom times and bust times in the commodity cycle. And right now we're still in one of those boom times where they are just raking in profits. But what's nice is that Exxon manages the balance sheet so that it can survive during the boom and bust cycles. They have $33 billion in cash on hand, which is great. And they've lowered their debt from $69 billion during 2020 all the way down to $40 billion now. So it's very impressive that ExxonMobil has been able to keep their Dividend King status throughout all these boom and bust cycles. They manage the balance sheet not only so that they can reinvest in their business during those times, but so that they can keep paying shareholders even during the downturns. But what does this mean for me as an investor? I'm not buying anytime soon of this stock. I'm only going to buy oil companies during the down cycles, and if they're trading at a good discount during those down cycles. But I am more than happy to just collect my dividend payments, reinvest, and get my 11% yield on cost. So yeah, I'm going to hold on to Exxon for a long time. Stock number 4 is Visa, ticker symbol V. I have 61.38 shares with 0.38 coming from dividend reinvestment. Current price is $271. Cost per share is $229. Total value $16,600. Dollars invested, $14,000. That's an 18.42% gain. And this is one of my newer investments in the past couple of years. And this is a low yield, high growth company. So Visa, even though it's fourth in my portfolio, it's way down there in total dividend income, only $127, 0.9% yield on cost. But let's dive into that stock and you'll see why I love it. If you go to my YouTube channel, my entire last video is actually analyzing Visa stock. So I recommend you watch that. I'll be a little more brief this time since I just went through it all. Consistent high growth of earnings per share. I'll give you the little spiel. So Visa, it's thought of as the credit card company, but you really need to break that image of it in your mind. They're a digital payment network, and they're more of the middleman that processes and authorizes transactions and then does some services on the back end like security. So they operate the network. They're not responsible for the credit of individual consumers, really. And digital payments is the name of the game. Don't think physical card, just think digital payments. Physical cards are on their digital payment network too, but you really have to broaden the scope of what you think Visa is capturing here. This is an ultra high margin business with 80% gross margins and 52% net margins. And that's because their business model is very scalable. I just went into this in the last video, how the cash from operations has just scaled significantly with very minor increases in capital expenditures to reinvest in the business. So it leads to just an explosion of free cash flow. And they pump that money then into share repurchases and a growing dividend. You can see how the share count has just declined about 2% a year. The dividend is growing at a very high rate, 17.92% over the 10-year compound annual growth rate. The 3-year compound annual growth rate is 17.57%. The most recent increase was 15.56%. I'd expect the next increase to be just as large, if not larger. The payout ratio is extremely low at 19% of free cash flow, 20% of net income. Revenue is growing at a 13.46% 10-year CAGR. Free cash flow per share is growing at a 25.7% 10-year compound annual growth rate. I expect this trend to just continue over the long term. It really is just a fantastic business, great business model, huge economic moat and competitive advantage. They're the #1 digital payment network in the space. And a lot of these characteristics are shared in MasterCard as well. So don't think me not owning MasterCard is some like diss at MasterCard. It's just that Visa is at a larger scale and trades at a cheaper valuation, and the growth is around the similar amount. So I felt more comfortable going into Visa, but I might own both in the future. They're both fantastic. Oh, and if you also saw in my last video, I relaunched my Patreon, which is at patreon.com/dividenddata. If you join and become a member there, one of the perks is that you can write in questions that I'll answer every single week. And we got one question this week, and it's specifically about Visa stock, so I'm going to answer it right now. So Andrew writes in, he says, I love the decision on buying Visa stock, as that is a position I am also eyeing right now. How do you feel about the high number of credit card debt as risk for consumer default and increased delinquency? The issue might lead to tighter lending standards and limiting who qualifies for Visa and MasterCard transactions. AXP, which is American Express, is more restrictive on who uses their cards, though they also hold the credit debt, unlike VNMA, who just manage the transaction between the customer and the banks. Thanks for all you do. Love the content. Yes, so like you say, American Express is more restrictive on who uses their cards, which is the responsible thing to do, given that they actually are responsible for that credit card debt themselves. And Visa and MasterCard, they don't directly deal with that in any way. So what you're talking about is more of an indirect effect here. And the concern of credit card debt among consumers, people have been worried about this for decades, it feels like. And as I'm intellectually thinking about this right now, I'm not sure that it will really impact spending long term. And whether this is a good thing for people or not, I think consumer debt will likely just continue to grow. So I really don't factor it in a lot in my Visa stock analysis. And I look at it more as a gauge on transactions and transaction volume. And I think that digital payments in general will collect more transactions and more transaction volume into the future. And in terms of the status of the consumer, some of them on the lower end will obviously not do well because credit card debt is terrible. As I think about it, I really don't see a version where digital payment transactions don't increase in terms of transaction and volume, which will increase fees that go down to Visa in the long run. So that's my thoughts on your question. I love the questions. Write them in. This was a pretty packed video, but I'd love to have a bunch of questions in future videos that you guys can ask me. We can go a little off with the topics, but stock ones are good. And again, this will be every single week for the video. So join patreon.com/dividenddata if you want to ask questions. There's a 7-day free trial. You also can download my 3 portfolios, which I'll upload as a CSV file for download every month. You get access to our Discord community, 15% off merch. But let's round out this portfolio update with stock number 5. Broadcom, ticker symbol AVGO. This is one of my newer additions and my best buy of 2023. I have 11.29 shares, 0.29 of which come from dividend reinvestment. The current share price is $1,300. My cost per share is $562, and I have a 142.61% gain. That is a $9,000 unrealized gain. In terms of annual dividends, this is $237.24. My yield on cost is 3.64%. And if we dive into the stock research page for Broadcom, you can see that the stock has just completely exploded since spring 2023. And a lot of this, in my opinion, was not justified by the earnings so far. Historically, the earnings were fantastic, and I did think the stock was undervalued for a long time, hence why I bought it in 2023 during March. However, since then, the stock price has surged insanely, and the earnings has not reflected this at all. And I think a lot of this is from AI-related demand among investors to get into semiconductor stocks. However, not all semiconductor stocks are created equal. Broadcom is barely involved in the AI supply chain. They have a couple little products, but they're not a core part of that at all, and it's not a core part of their business. Yet the stock has soared to sky-high valuations, and it actually makes me a little uncomfortable about the stock. It makes me kind of want to sell a little bit of it, but I was very happy with my purchase price, and I did want to hold it long term when I bought that price. That was my plan. It wasn't a trade. If I'm going to play the devil's advocate here, they did just complete their acquisition of VMware, so now they're about a 50-50 software business and semiconductor design business. And I do think that's a great strategic long-term move, and you have seen this boost their revenue slightly in the latest quarter, so this is still just like getting into their stock valuation. So the business is going to continue to grow. Free cash flow per share is growing at a 35.97% 10-year compound annual growth rate. However, this has slowed down in recent years at a 13.77% 3-year CAGR. The dividend has seen consistent annual growth for a long time here. 10-year compound annual growth rate of the dividend is 34.55%. The 3-year CAGR is 13.4%. The most recent increase is 14.13%. It's a very sustainable dividend. Around 43% of annual free cash flow as of 2023, 54% of annual net income. I expect dividend growth into the future. And one of the things that I love about Broadcom as a semiconductor business, if you've been following me for a while, I've gotten turned off to many semiconductor stocks due to especially ones in manufacturing, because they have massive capital expenditures and are usually low margin too. Broadcom's semiconductor business is in design, and they don't manufacture the chips themselves. They get them manufactured by Taiwan Semiconductor. So it's through a third party. So they don't have to reinvest into manufacturing at all. And the company is a cash flow machine. And this is what I'm talking about. So 2023 fiscal year, they had $18 billion in cash from operations. Capital expenditures are only $452 million. So $17.6 billion into free cash flow, which they then fund into share repurchases and dividends. And they use that cash also to fund acquisitions, such as their VMware acquisition they just did. And I guess to understand this, you really have to compare it to other companies. So we'll look at Intel here, which was one of my worst investments, but it was a big learning experience in terms of understanding how large manufacturing capex can impact a stock's earning potential. So Intel, for example, in their most recent fiscal year, they only generated $11.4 billion in operating cash flow, but they spent $25.7 billion in capital expenditures. And I've made videos about it in the past. I know the reasons why, But still, when you compare 400 million to 25.7 billion, how are you supposed to distribute cash to investors when you're spending that kind of money? You can't, which is why Intel cut their dividend massively. They had to. And a company like Broadcom, they don't have to invest in manufacturing, and they can leverage other companies spending that money and just use their technology. This is the fabless semiconductor model. NVIDIA is one of the most successful examples of this, especially in this AI term. They're a fabless company, so it gives them fantastic business economics, and you really see that once they had this recent surge. Oh my God. They just are raking in cash that they can distribute to investors. So yeah, this most recent quarter, they had $14.9 billion in free cash flow in one quarter. And let's look at that. CapEx for that quarter, $369 million. What are we talking about here? That's so much cash that can be actually used in the business or distributed to investors. Acquisitions, buybacks, dividends. All right, so that is the end of this dividend portfolio update. Again, it's available at dividenddata.com. You can see my full portfolio on the stock picks page. You can track your own portfolio. You can use my stock research tool, which is great and only getting better. And remember, people, the summer sale, 50% off. You can get dividenddata.com for 50% off both the monthly and annual plan for a limited time. Use the promo code SUMMER at checkout, SUMMER. This is lifetime pricing, so get it while it lasts for new customers. And I'm very excited to be working on future updates. It was a lot of fun putting this together recently, and I have a lot of ideas I want to get to work on. So thank you guys for the support. Really, it does mean a lot. But anyway, see you next week, and thank you for watching.